Through the first half of the year, the U.S. economy operated like a finely tuned machine. Forecasters expected the labor market to continue steady growth. This chart shows exactly where that expectation derailed. Instead of adding the thousands of jobs predicted for July, the economy reported an unexpected loss of 23,000 non-farm payrolls. When hiring turns negative unexpectedly, the focus shifts from growth to sustainability. This single report raises questions about whether the labor market is entering a broader contraction. Headline data appears stable, with the unemployment rate holding at 4.1% in July. But this is deceptive. A secondary line shows labor force participation dropping to 61.4%. When individuals stop looking for work, they are removed from the active pool and no longer counted as unemployed. Compounding this, the Bureau of Labor Statistics also revised previous month's employment estimates lower. A steady unemployment rate is an illusion if the underlying pool of workers is shrinking. The market is weaker than the top-line percentage suggests. This puts the Federal Reserve in a difficult position as it attempts to manage its two primary goals, maximizing employment and stabilizing prices. The standard policy response to job losses is to lower interest rates, making it cheaper for companies to borrow money and restart the hiring process. This scale visualizes the roadblock to that response. On one side is a weakening labor market. On the other, consumer surveys show inflation expectations are stuck at roughly 3.6%, well above the Fed's 2%. The central bank is now in a position where prioritizing price stability could directly undermine employment, while prioritizing jobs could leave inflation unchecked. The effects of this interest rate dilemma are visible in the housing market, where the average 30-year fixed mortgage reached 6.69% in early August. At 6.69%, the cost of borrowing compounds over 30 years, adding hundreds of thousands of dollars in interest to the total price of a standard home. Consequently, the market is paralyzed. Potential buyers are priced out by high rates, sellers refuse to give up their current low-rate mortgages, and builders are adjusting their plans for new projects. These elevated rates act as a bottleneck for the entire economy, freezing major consumer milestones and reducing overall spending. Because consumer spending is the primary engine of the U.S. economy, the health of the system relies on households having both stable wages and affordable credit. When households face a cooling job market and high borrowing costs, they tend to build cash reserves and delay large purchases like cars or homes. When this cautious behavior scales across millions of families, the reduction in spending drags the broader macroeconomic system down with it. Curious to these growing pressures on Main Street, the stock market actually reacted positively to the weak July jobs data. This reaction is based on investor speculation. Bad economic news increases the likelihood that the Federal Reserve will be forced to lower interest rates sooner to prevent a recession. Wall Street is betting on a controlled slowdown, a scenario where conditions weaken just enough to lower borrowing costs without causing significant corporate damage. Investors are treating the job loss as a potential catalyst for easier monetary policy, even though those same losses suggest a weakening environment for corporate earnings. There is a specific scenario that remains the ultimate risk for the Fed and the markets: stagflation. This chart visualizes the scenario. Economic growth and hiring fall on the bottom axis, while inflation remains stubbornly high on top. This neutralizes the Fed's tools. Raising rates suppresses the job market, while cutting rates risks entrenching high prices. To determine if the economy is trending toward this trap, we must monitor 5 specific indicators: inflation, unemployment, wage growth, mortgage rates, and consumer spending. The U.S. economy is not collapsing today, but the July report is a warning. Navigating the space between persistent inflation and a cooling labor market requires looking past individual headlines to track these long-term trends.